Okay, we are live on our training. So today is March 25th, 2024. It's a Monday, and let's get to it. My name is Greta Kudo. I'll be your trainer today, and we're talking about understanding MCAs. Most of our messages involve understanding MCAs, so I want to do a little overview about it. And if you already know these, you don't have to watch this training. If you don't, here's a good chance for you to understand it. So key points for the training would be overview of MCA, how MCAs work, key features of MCAs, advantages and risks of MCAs. In other words, when I say risks, I'm not talking about clear disadvantages. It's just there are risks to it and the ideal candidates for MCAs. So what does MCA stand for? It stands for Merchant Cash Advance. And this is all we do. It's a form of business financing where a company receives a lump sum of money in exchange for a percentage of its future credit card or debit card sales. So we're lending you money in hopes that you're going to make money back. And from the money you make back, a percentage of it goes to us when we lend you the money, right? So note that it is not a loan in a traditional sense, okay? It is a cash advance, but it's based on the business. That cash advance is based on your business profits, future business profits. So how does it work? A business agrees with an MCA provider or an MCA lender who advances them the sum of capital that they are seeking, or the sum of capital that they are qualified for per se, not that they are seeking, because people could be seeking 100,000 or qualify for 25, right? And actually, people could be seeking for 100,000 and qualify for 250. So it just depends. So in return, the business commits a portion of its daily credit card sales to the provider until the advance, along with a predetermined fee, is paid in full. So with the advance, there is a predetermined fee, just like every loan is not, this is not specific to MCAs. Every loan has a predetermined fee usually. So you're borrowing so amount, the interest rate is so amount. This is, you know how much you're going to pay back, right? Spread out within a term. So in MCA, of course, that applies as well. So this means that the repayment of the loan is tied to the business's sales volume, and the higher sales, that you make, the faster you repay it, right? So which is amazing. So if you're paying a certain amount, it's a fixed amount that you're paying back that is agreed upon. If you're making more money than was originally anticipated, you will be able to pay it back faster. So because it's based on percentages, the paybacks are based on percentages, right? Daily, weekly, bi-weekly, monthly. They're based on percentages. So the higher money you make, the higher percentage, or the same percentage, but when you convert that percentage into actual money, it could be higher or lower, depending on how much it is. So what are the costs and fees of this? The cost is typically higher than a traditional loan. So when you, as a business finance consultant or an agent or whatever, on ISO, you know that, hey, it is more expensive than getting a traditional loan from the bank. So we're not even going to dispute that with anybody. You should know that already. But that's not why people borrow the money. Anyway, MCA lenders or MCA providers, they use what we call a factor rate. A factor rate is not an interest rate. So just in case a client asks you, what is the interest rate? You should know that it is not termed an interest rate. It is termed a factor rate. The correct lingo, just like every industry have their own lingo. So you have the opportunity to, let the client know that it's not an interest rate, is a factor rate. So the provider uses the factor rate to determine the cost of the money that they're lending out, which is multiplied by the advance amount. Advance amount means the amount they're borrowing or the amount they qualify for. So for example, if they're seeking 100,000 and they qualify for 100,000, advanced at a factor rate of 1.25, the business would need to repay 125,000. So they borrowed 100,000, they're paying back 125. That means that the discrepancy there is 25,000, right? So that is what they're paying back. That 25,000 is added in to the 100,000 and spread out within the term of the advance or the loan. So just keep that in mind. So this cost structure can translate into high annual percentage rates. It is a very expensive money. We don't dispute that, but whoever gets it for a particular reason. We're not here to, you as a business finance consultant, you're not here to talk them in or out of it. So you tell them this is what it is. If you need the money, this is what it is. If you qualify, this is what it is. So we give them an offer, they accept it or they not. They don't have to accept it. So what are the repayment schedules for this? Unlike fixed loan payments, MCAs are repaid with variable amounts based on daily or weekly sales, sometimes monthly. Most people don't qualify for monthly sales, but if you do qualify for monthly sale, it's mostly because um, or monthly payback. It's mostly because you have borrowed the money first and paid it back, and then the next time you're borrowing it, they will give you or will give you a more conducive repayment structure. So this can be beneficial for businesses with fluctuating sales, but may also result in higher payment amounts during peak periods. Remember, it's the percentage. So we give them a percentage. Let's say, remember, you're loaning them money. We're loaning them money based on a promise that their business will return future dividends or profits, right? So let's say the agreement is we're going to be taking 20% every day, right? So if they're making $100 and we're taking 20%, so there you go. That means you're taking $20 every day, every day, every day. But if they increase from making $100 every day to making 1,000 every day, it's still going to be 20%. But you're now taking, instead of $20, you're taking $200, right? Because they went from making $100 a day to making 1,000 a day, right? And if they make more than 1,000, like 10,000, you're going to be taking 200. You're going to be taking 2,000. So that's how it is. But it helps them pay it faster. But just so you understand, when this subject comes to light, so your client asks you those questions, you can respond accordingly. So what are the advantages of MCAs? The MCA provides quick access to capital, undisputed, better than any loan out there, loan out there, often within 1 to 3 business days. Sometimes same day as the application. Well, depending on the business, depending on their qualification, all that. But yeah, it's fast access to capital without the need for collateral. Most funding categories require collateral. This one doesn't. And most funding categories require uh, credit scores to qualify. Credit lines require that. Traditional bank loans require that. So one way or another, they want you to have some skin in the game, right? Us, we just ask for revenues. We want them to have revenues, and their revenues qualify them to get the loan. So technically, it's not really a skin in the game. If you think about it, we're at risk more than um, they can ever imagine. Just having faith, believing that they can repay us when they said they would, right? So the business, they're particularly appealing to, these are loans that are particularly appealing to businesses with high credit card sales volume and those that are needing fast funding and those that are unable to get bank loans or traditional loans. So this type of funding is available to them and it's very appealing to them. They can get the money faster. For example, business wants to do a payroll, they don't have the money in their banks, and they need the money right now. Otherwise, chaos is gonna ensue immediately in their company, right? What do? They need money fast. MCAs usually what their go-to is. They can pay it up, they can pay it fast, or they can get the money fast and pay it up fast, and get to the next need for funding. So it's appealing to them if they have high credit card sales, and it's appealing to them if they're in need of fast funding, and it's appealing to them if they're unable to secure traditional financing. So what are the risks to consider if you're getting an MCA? The convenience and the accessibility of MCA come at a cost. They do come at a cost. The high fees associated with MCAs can strain a business's cash flow. Keep that in mind. Keep that in mind before you get an MCA. We tell you this, it's not hidden. It's not for everybody. Actually, I just spoke with a prospective client. Well, not really a prospective client, but someone that called to inquire about getting funding. Right? They already have experience with the MCA in the past, and they don't want it. So, and they're making $250,000 a month, and it's a construction business, by the way. They're making 250K a month, but they've had, to get MCA in the past and it wasn't favorable for them. So it's not favorable. We're not here to convince you if it's favorable or not. It's not favorable for every business. It's only favorable to those that are in need of it and they know what to do. And one of the benefits is also that we're not on your behind checking whether you use the money for what you said you're going to use the money for, like the banks do. So there are advantages and there are disadvantages, right? Just keep that in mind. So additionally, the lack of federal regulation with MCAs means that terms and conditions and practices, they vary greatly between lenders. So mostly the lenders are the ones, or the businesses are the ones that regulate their own business and say what works for them, because there's not really a federal regulation for it. Why that? That's because it's very risky on the side of the business lender or the MCA lender, and is even more risky on the business lender than it is on the consumer, which is the one looking for the funding. If it was more risky on the one looking for funding, federal regulations would jump on it immediately because there will be more complaints about it. But it's more risky because you'd be surprised, some MCA lenders end up not getting their money back, right? So they lose money there because there is no collateral, nothing to hold, nothing like a skin in the game from the consumer to hold them responsible for it per se. So the only one of the most I would say punishments that consumers get from it is that nobody else is going to lend them money because they already defaulted on the loan, right? So here, it's important to understand this is a crucial decision for your business, and we advise that you read through it thoroughly with an attorney, with a CPA, whatever it is you have. Read and understand the agreement that you signed with an MCA lender before you do it. Yes, you need the money. Yes, the money can be provided to you fast, but read and understand it before you pursue, move forward with it. So here are some of the ideal clients for MCAs: airlines, bakeries, beauty products, credit protection, cruise ships, hotel business, fencing, marketing, advertisement, moving companies, nails, salons, online pharmaceuticals, pawn shops, pool services, trucking, repair stations, restaurants, retail businesses, security services, staffing, and employment agencies. So these are industries that you can look into as a business finance consultant to try to get business from. So in summary, MCAs can be viable options for certain business financing needs, right? Not every business financing needs, just like even traditional loans are not for every business. Lines of credit are not for every business. So this is the way it is. So it's not a surprise, but it's mostly appealing to businesses with robust credit card sales and their need of quick capital. Very simple, guys. So we made this training very simple for you to understand. Now, however, due to their high costs, the high cost of the money, right, and the potential for a cycle of debt, they should be approached with caution. We advise you to approach it with caution, and often it is considered a last resort after exhausting other financial or financing options. If you are trying to get an MCA, try to get everything else first and see if you qualify. And if you don't, then try to get an MCA. You will most likely qualify with an MCA because it's a low barrier of entry, but very expensive because of the convenience and the accessibility of the money. So that's why, if you need the money, if you want the money, MCA is not for people that want the money. It's for people that need the money to stay in business and all that good stuff. So we are in business of the last resort. That's what we are. Okay, business finance consultants. We are in business of the last resort, and there's so many businesses that need the last resort because banks only lend money to like I think 1.8% of businesses. They don't lend money to like 98% or 99% of businesses. So they put businesses in the last resort category, which draws them to us. All right. Anyway, next training we're going to be talking about Facebook marketing, and keep in mind you're not required to join our training, but if you need a training, we're now going to be uploading it once every week. So you guys, if you have any questions, email training@moniphy.com. If you have any questions about um, any subject on when it pertains to MCAs, we're going to be talking about in the next few videos. We're going to talk about marketing in general. How do you talk to clients? How do you target clients? And all that good stuff. If you know anybody looking for a career in our industry, hey, have them send their resume to jobs@monify.com. So send in their resume to jobs@monify.com, and we will look into it and see if we can bring them on board. But yeah, that brings us to the end of our training today. Have yourselves a wonderful day. Bye-bye.